Name the country. If any government or a corporate which is there in that country wants to raise capital through bonds, they don't have a choice. They have to get it rated through one of these three American companies: the Fitch, the Moody's, or S&P Global. These three are the monopolies worldwide, irrespective of the fact that it is going to be denominated in the US dollar or euro or sterling pound, irrespective of anything. If it has to be traded globally, one of these three firms have to audit and bless it. Now, here is the clincher. How did these three companies become so strong world over and win the trust of the entire world, including China, Russia, until recently? How did it happen? Stay tuned. Imagine Amazon suddenly removed all customer reviews. No star ratings, no Amazon choice, no seller feedback, just thousands of sellers claiming everything is high quality. Now imagine you want to buy an expensive laptop or phone, but every seller will now look the same. This is exactly what the investment world looked like in the late 1800s. Thousands of railroad companies claiming they were reliable, but no one knew the truth. So, think of Henry Varnum Poor as the first Amazon reviewer. He manually, painstakingly collected data, verified numbers, and published financial reviews of railroad companies. Not for free. He sold those reports as books, just like someone selling a detailed laptop buyer guide 2025. Then came Moody, Mr. John Moody, in 1909. Of course, he didn't make it free either. He sold rating manuals that graded bonds A, B, C, exactly how Amazon grades sellers with star ratings too. Investors bought these manuals as well because they wanted to avoid getting cheated by unreliable companies. In short, Henry Varnum Poor was the first trusted product reviewer, John Moody the first to turn reviews into standardized ratings. Investors or buyers who are trying to avoid bad purchases, railroads or bond issuers are the sellers claiming they were of high quality. Their rating system was born the same way modern platforms solve trust problems, by creating information that buyers can rely on. We hear about credit ratings all the time: AAA, triple B, junk, but very few of us know where these ratings come from, or why three private American companies have the power to decide how expensive it is for an entire country to borrow money. So let's rewind the clock. In the beginning, ratings were not born on Wall Street. In the late 1800s, America was building railroads at an unbelievable pace. Investors across New York, Boston, and even Europe wanted to put money into this boom. But the problem was simple: no one knew which railroad companies were trustworthy. So, Henry Varnum Poor started publishing detailed financial information on railroads. This was the seed. And in 1909, John Moody published the world's first very bond ratings, assigning grades to bonds just like teachers grade students. Back then, ratings were only opinions, no regulation, no power, just information. The turning point when opinions became law. But everything changed after Great Depression. Banks collapsed, investors lost confidence, and regulators needed a simple way to say these bonds are safe, these bonds are not. So, in 1936, the US government made a historic decision. Banks could only hold bonds that were investment grade. And who decides that? The credit rating agencies. This is the moment when a private opinion became a regulatory requirement. The agencies didn't ask for this power, but now they had it. Then followed the monopoly era. The issuer pays and NRSRO. Fast forward to the 1970s. Photocopiers made it easy for investors to share rating reports. Agencies were losing money. So they switched models. From investors paying for ratings, the companies paid to get rated. This is like students paying teachers to grade their exams papers. You can imagine the conflicts that would now follow. Then in 1975, the SEC created a special label called NRSRO, Nationally Recognized Statistical Rating Organization. Only a handful of agencies received the status. Competition disappeared. Moody's, S&P, and Fitch effectively became the official gatekeepers of global credit. The rise reaching the entire world. By the 1990s and 2000s, their power exploded. Everywhere you looked, government bonds, corporate bonds, municipal bonds, structured products, everyone needed a rating. Banks, pension funds, index providers, all were forced by regulation to use these ratings. A simple system that began with railroads has now become a multi-trillion-dollar global infrastructure. And then came 2008, the crisis, the AAA rating to collapse. Credit rating agencies stamped AAA rating on toxic mortgage securities. These instruments collapsed spectacularly. Investigations showed how conflicts of interest, flawed mathematical models, and pressure to maintain market share all contributed. Yet, despite their mistakes, the system still only relies on them. So, what is the reality today? Today, more than 95% of all global credit ratings comes from the same three US firms. Governments cannot raise money internationally without them. Large companies issue bonds, impossible without their blessings. A rating is still an informed opinion, not a guarantee, but the entire financial world is designed to follow it. So, what it means for us? So, what should a retail investor take away from this? It's simple. A credit rating is a useful compass, but it's not a map. Let us use this as a starting point and never as a final answer, because behind every rating is human judgment, incentives, and models that can go wrong. Understanding how the system was built makes us a smarter investor. And in the world of money, awareness is an advantage.
In the next section, let us find out currently who are the investors who own these three companies, which of them are publicly listed, the Fitch, the Moody's, or the S&P Global, and to what extent do they have a market capitalization. Stay tuned.